Okay, thanks. So this is my great pleasure to invite you and to be the moderator of this session. And due to the lack of time, let me start calling for Elham's Saeidinezhad, who is an assistant professor of economics at Barnett College, Columbia University. She also teaches in she also teaches the modern money and banking, the financial system course at the NYU Stern University, and she also writes many columns for like the economic questions website, and she is one of the great contributors to the MoneyView ecosystem, and she uses its apparatus very often. And I kindly ask you, Elham, to talk about your presentation. You will have around 15 minutes, and after Chris is going to discuss your paper. And while you are speaking, I'm going to share your paper's link in the chat. Thank you.
Thank you so much, Adam. Thanks everyone for being here, and thanks Adam for the nice introduction. So basically this is, well, can you see my slides? Okay, perfect. So this is going to be this is a very long paper. I'm gonna try to make I make sure that I explain the main concepts and the main findings of this paper in 15 minutes. As you can see, the topic of this paper is the effects of valuation as a cost of filling dollar funding gap. And I'm going to think about the hierarchy and also the dealers in the FX swap market. So basically, like, this is the outline of the paper, but basically let's start with a very brief introduction about this paper. So here I'm trying to actually connect two different literature with each other. In one literature, which is kind of like monetary economics literature, we see that the main focus has been on how to basically, for some reason I can't change this slide. So if you don't mind, I'm going to, my computer has just frozen. I'm so sorry. Okay, it's working now. So basically, like when we think about like the US dollar funding market from monetary economics perspective, most of the attention has been on the US repo market. At the same time, when we examine international finance literature and when we focus on the FX swap or foreign exchange swap, we see that most of the focus in this particular literature is basically on FX swap mispricing, which is the deviation from cover interest parity or CIP. But in this paper, I want to examine financial stability in a sense by kind of connecting these two markets together, the US repo market, and therefore the domestic US money market, the Euro-dollar market, and FX swap market. The idea is that one of the reasons that these two markets, FX swap market and traditional money market, is basically are treated differently from each other is that usually this deviation in CIP, which is called FX swap mispricing, is considered as, again, a mispricing and FX swap, but once we actually examine this deviation with the and compare it with the developments in the money market, we see that CIP deviations usually happen when we see the impairment of liquidity in the Euro-dollar market or offshore US dollar funding market. But these two are, I mean, obviously Borio and BIS are concentrating on this focus, or I'm sorry, are concentrating on this point, but these two relationships, the CIP deviation and impairment of liquidity in the offshore US dollar funding, is something that is very missing in the literature. So this means that there is not enough attention on this spillover effect between wholesale money market and FX swap market. At the same time, the dealers are one of the reasons that this spillover effect is not being investigated that much, is that we are not focusing on the dealers that are connecting this market. As most of you already know, most of the financial theories and monetary theory are based on these arbitrages, the arbitrages that are basically exploiting these arbitrage opportunities and are trying to basically connecting this market. But when we look at the market from market practitioners' point of view, something that Professor Menand has done extensively in his work, we see that these are not the arbitrageurs, but rather the dealers that are basically connecting these markets. And the goal of the dealer, as we know, is very different from arbitrager in the sense that as arbitrageurs want to kind of like exploit that profit that is available because of the difference in prices, while the dealers are actually making the market, and that spread, the difference between their bid and ask prices, doesn't necessarily reflect the change in prices in two different markets. So when we examine the business model of the dealers and compare it with arbitrageurs, we see that we really can't use arbitrageurs as proxy for the dealers all the time. So dealers have very distinct business models. But unfortunately, while arbitrageurs are fully present in financial and monetary models, the dealers are missing. So again, something that an element that I am adding to this literature to make sure I can develop a model that helps us understand this spillover effect between FX market, FX swap market in particular, and wholesale money market is the dealers. So what I'm going to do is that basically I'm going to introduce a dealer-centric model of FX swap. And the idea is that this model, which is based on the ideas that giants have already kind of like introduced, is enabling us to basically connect these three type of markets. And specifically in this model, I'm going to use three dealer-centric fundamentals. So what are the fundamentals? When we think about any type of model or any type of asset pricing, the idea is that, well, there are fundamentals associated with different markets and different assets that determine the value or price of that asset. This is a very standard way of thinking about asset pricing. So one of the things that I'm doing here is that I'm going to use this understanding of a standard financial models. But what I'm going to do is that I'm going to focus on different type of fundamentals. In particular, I'm going to focus on three dealer-centric fundamentals. So the first thing is I'm going to assume the price of FX swap is being determined by FX swap market liquidity, and I have developed a measure of this market liquidity, which is dealers competition. Also, I'm going to talk about dealer funding liquidity risk, and I'm going to say that what we call CIP deviation is indeed nothing but the funding liquidity risk that the dealers are facing. And indeed, if anything, not only CIP deviation is not a mispricing of FX swap, rather it is indeed one of the fundamentals that determine the price of FX swap. And the third fundamental that I'm using is the cost of market making. And the cost of market making is being used or being captured by dealers as spread. I'm going to kind of like, right now, I want to say something. And when we think about the standard indexes that capture market liquidity, we see that in most literature, in most financial economics literature, dealers' spread are being used to capture market liquidity. But I just want to kind of like highlight the fact that this model is also in this regard is deviating from standard financial economics literature. So why? In this model, when it comes to capturing market liquidity, I'm focusing on one aspect of market liquidity in particular, which is about like whether the sensitivity of prices to the size of the deals. And so what I'm basically claiming here is that this aspect of market liquidity in this imperfect world of modeling that we have to just pick and choose the most important criteria is the most important criteria when it comes to market liquidity and whether an asset is liquid or not. I mean, for those of you who are interested in this literature, I just wanted to say this kind of like fun fact about the measure that I am using to capture market liquidity and how it is different from the standard measures. At the same time, I'm using this dealer's spread as a measure of the cost of market making. So what I do next is that I have identified 3 trends that are reshaping the FX swap market. And these trends are basically changing the supply side or the dealer side of the FX swap market. And the goal is basically to use this model to finally understand the impact of these trends on dollar liquidity and also the price of FX swap. So the key takeaway of this paper would be like, when it comes to intermediaries and the tools in offshore dollar funding market, we are going to see structural changes in market microstructure in Eurodollar market. When it comes to the intermediaries in this market, we have to kind of like forget about the bank-centric, even banking dealers or even bank dealers. We have to kind of like deviate or forget about bank dealers, but rather most of the intermediaries are going to be basically like prime brokerage firms. I don't think there's enough time to talk about prime brokerage, but the business model of prime brokerage firms are extremely exciting and interesting from intellectual perspective, but from liquidity perspective, it's a very disappointing business model. So the goal is that the intermediaries are changing. Perry Merling has already identified that, well, it's not about like banks, it's about like dealers, and that's correct. But what we are seeing around is that it seems like the future is not dealer anymore, but a prime brokerage future. At the same time, when it comes to the tools in this offshore dollar funding market, well, as of now, the most important tool has been the Eurodollar loan, this interbank loan. And what we are seeing in the market is that the tools are also changing. The tools that are funding this global supply chain, if you want to connect it to the real economy or international borrowing, and instead of using loan, we are using off-balance sheet tools such as FX swaps. So we are using derivatives to finance this global supply chain. So this is also one of the interesting changes in market structure. So the other thing is that when it comes to indicator, well, there's so much debate about this kind of like movement from or transition from LIBOR to SOFR, but what I want to argue here is that, well, maybe that is not a very relevant, or at least in the near future, that's not going to be the relevant concern anymore. But the main concern is going to be if you really want to capture the cost of dollar funding market, the main indicator may be the implied FX swap rate. Therefore, in this context, the persistence of the basis is going to be the permanent feature of FX swap pricing, because the basis is going to reflect this extra demand for FX swap in order to obtain offshore dollar funding market, offshore dollar funding. And so when it comes to liquidity, I'm going to I hope I do have time to show you that, but I'm going to show you that the combination of the structural changes and applying the model to understand these structural changes probably are going to tell us that the market is going to be less liquid and more expensive. At the same time, this means that if you want to have access to cheap dollar funding in the future, even more than now or before, your proximity from the Fed's balance sheet is going to be extremely important in determining the cost of funding for you. And that's that hierarchical aspect of this model to understand FX swap and offshore dollar funding. When it comes to financial stability, well, let me talk about regulation, something that Lev has written extensively in his paper, and he's going to present later today. But when it comes to regulation, I don't need to tell you that, you don't need me to tell you that, regulating synthetic assets such as derivatives is extremely important for every type of financial regulator, and especially the Fed, that is not designed to do so. At the same time, the idea, well, if funding is really happening through derivatives market, then the question is, do we really accept the Fed to become the dealer of last resort in international FX swap market, or is it a bridge too far? And then the third implication would be definitely the political stability of the Fed, and again, like the combination of funding through derivatives and Fed's support of such funding, I would say that is going to create important challenges for the Fed. So this is a huge part of the paper. As a matter of fact, I would say that one of the argument, or one of the contribution of the paper would say that is to add to the existing understanding of FX swap and use 3 financial engineering tools to kind of like show it to you that FX swap is being used as an alternative to Eurodollar loan, not as a result of an accident, but it is actually something that is inherited in the design and engineering of FX swap. These 2 tools are contractual equations, the cash flow, showing the cash flow stream, and also the balance sheet. If you are interested in contractual equations, which are extremely exciting tools, I encourage you to learn it. It's just very, very exciting. I'm more than happy to talk about it, but I'm not gonna talk about it now. But I'm also not really gonna focus on the cash flow stream, but I want to, for now, just focus on the balance sheet comparison of FX swap and repo to show you these 2 tools are indeed not very different from each other. So this is basically an example that, let's assume that you are a British pension fund, and let's assume that when you are starting your position, you have no debt, which means that you have this asset which is in cash, it is denominated in the British pound, you have your liabilities, again you have no debt. Now instead your capital, and your capital is denominated in British pound, so then you want to just kind of invest. You just want to invest and purchase a US dollar or a US dollar denominated security. So you have 2 choices. The repo choice is more obvious. For the sake of time, I'm going to focus on the FX swap choice. So the transaction is going to be the same in both, like this the net basis and the gross basis of that we have shown here, but this is only the difference in accounting. So what is the transaction? So in this case, what you are doing is that you are a pension fund, you are going to actually basically like purchase those US dollar denominated assets, let's say US Treasury. You are going to purchase US Treasury, but to make sure that you are being hedged or protected against the fluctuation in FX, fluctuations in foreign exchange risk, you are going, or fluctuations in exchange rate, or you are hedged against foreign exchange risk, you are going to enter a simultaneous forward contract as well. And in this forward commitment, you are going to basically like sell those those securities to the counterparty, which is usually a dealer, and you are going to be promised to receive the fixed amount of cash in British pound. So this is from the point of view of hedging, but if you think about it, the same argument can be made in having access to a hedged dollar funding at time t0, because let's shift our focus from, okay, you want to invest your British pound in US security market, but instead you want to exchange your British pound in order to obtain US dollar funding at time t0. But at the same time, you are a pension fund, you want to make sure that you are protected against foreign exchange risk. The point to emphasize is that these two simultaneous transactions, where the first one has its first leg at time t0 or a spot FX market, at the second leg is happening in the forward FX market. The combination of these two, once we actually show all the hidden commitments and rights as a result of these two legs of transaction, the outcome is going to be very similar to what we see in the repo. So in this case, in the first spot leg, what we see is that you have purchased this US dollar denominated security, therefore your asset is denominated in US dollar. In your liability side, you are still having this capital. Okay, this might show that you do have an FX mismatch, but once we actually also include all those hidden liabilities, we see that there is indeed no hidden mismatch, because in the forward contract, what is going to happen to you is that on the liability side, there is going to be this cash forward, which is denominated in US dollar. Therefore, your liability in the forward market has the same currency as, but is denominated in the same currency as your asset in the spot market. And if you look at the liabilities in the spot market, it is denominated in the pound, but your asset in the forward market is also denominated in pound. Therefore, there is no FX mismatch. At the same time, again, if you compare this balance sheet with a balance sheet that can be constructed by using US wholesale repo market in a set of FX swap market, you will see that these two balance sheets are almost identical. So again, this is one way of showing that this FX swap market is inherently a money market instrument. So,
and I'm sorry for interrupt. We are running out of time. Can you please?
How many time we have? So
maybe
I can just...
2 minutes.
Okay. So basically, this is the model. So in these 2 or 3 minutes, I'm going to use I'm going to focus on the model. Basically, like this is the model of this hierarchical dealer. This is the hierarchical dealer model of FX swap. So basically, here I'm only going to focus on 2 panels. Just before going there, in first panel, what we are seeing is that these are the developments in the FX swap market, and I want to see this you to see that in this the funding relationship between the dealers in the FX swap market and dealers in the wholesale money market is going to create this interconnectedness between these 2 markets. So in this case, what we are seeing is basically I'm using trainer model. I'm using trainer model of FX swap or dealers to basically examine how prices in FX swap market is determined. There are 3 things that I want you to focus in this. So the first one is basically like this, at point t0, what we do have is basically like a dealer that has this that has a matched balance sheet, which means that there is no inventories, there is no position here. But as we move to the right hand side, the dealer is lending US dollar in the spot market, and therefore it is becoming the lender of US dollar funding in the FX swap market, and it is establishing a long position. So what I want to focus is first this area. So this area, which is the equivalent of CIP deviation, is also capturing the US dollar funding gap, or the US dollar funding liquidity, the US dollar funding need of the dealer itself. The idea is that in this funding need is being, or at least traditionally, used to be financed in the wholesale money market. And the wholesale money market is basically like Previously, it was mostly dominated by large US banks, but now the liquidity providers are becoming US money market funds, which was one of those structural changes that we talked about at the beginning of the presentation. So the idea here is that this deviation from from the CIP, and after that, I'm more than happy to discuss why having a long position indicates a deviation from CIP is the equivalent of the dollar need of the dealers itself. The second item that I want you to basically focus on is basically like the slope of these two price lines. So the slope of these two price lines are going to show the sensitivity of prices to the size of the trades, and that's how I'm measuring market liquidity in this model. And in order to capture market liquidity formally in the paper, I'm associating that sensitivity with the level of competition among dealers in this private dealing system. The third thing that I want you to focus on is on the width of this line, which is basically the bid-ask spread. And then this bid-ask spread is capturing the cost of market making. So the combination of these three elements are going to generate or create the cost of FX swap, and therefore the cost of offshore US dollar funding synthetically or indirectly. But there are two more things that I want to say before finishing the presentation. The first thing is that when we look at the standard literature or the financial literature, and when we look at the decomposition of the dealer bid-ask spread, there are, for example, this spread is being determined by factors that determine the cost of doing business. But a structural change is happening in this market. More specifically, the dealers have started to capture the shareholders' interest directly into their quoted prices. And there's a very interesting literature here. And the idea is that as the dealers make the market, they are becoming more leveraged, because being a dealer is profitable only if you are actually using lots of leverage. So what this means is that the dealer in the meantime is becoming closer to, or the company or the firm, which is usually a public firm, is going to be a public traded firm, is going to get closer to that debt overhang point, the point at which it cannot borrow anymore. And at that point, the shareholders have to post their own capital, which is going to lower their return on equity. The idea is that that risk is being integrated into as a cost of market making, and that is also one of the reasons that the price of the swaps has increased. And the other thing that I want to say, and this is going to be the last thing, is that this gap that we see here in the previously, US banks were basically filling this gap, and the cost was not that significant. But as US banks are exiting wholesale money market outside the United States and money market funds are replacing them, two things are happening. First, their cost of offering dollar funding has just increased. And second, money market funds are less a stable liquidity provider. There are lots of things in this paper I want to discuss, and I'm more than happy to discuss the ideas further after the presentation. And thanks for giving me more time, Adam.
Okay, thank you. I think that we are running out of time, so this is to kindly ask Lev Menand, who is an associate professor of law at the Columbia University. He was also mentioned in Elham Saeidinezhad's presentation as an expert. And please, Lev, can you please hold your presentation? Thank you.
Sorry, I'm just sharing my slides.
Okay, thanks. You will have 15 minutes. Thanks.
You see the slides? Yeah?
Yes, we can see. Yes.
Okay, great. Thank you so much for including me in the conference. It's really exciting to be here. and to listen to everything the group is doing. My presentation is going to be a bit different from what you've heard so far. First, I'm going to focus at a much higher level of abstraction. I'm looking at the monetary system institutionally and as a whole. Second, I'm a legal scholar, and so my project is about law, explicating the legal framework for money and banking, in particular the US framework. And I see that framework as designed to solve a basic economic governance problem, namely creating a sufficiently elastic money supply in a way that's politically legitimate. And third, I'm interested in denaturalizing monetary arrangements. So our money is hybrid, as Professor Merlin says, but that hybridity itself is a policy choice, and the nature of that hybridity, the balance of public and private, has changed dramatically over the course of US history as the nature of the legal regime governing the role played by private investors has shifted. And so unlike most scholars who work on banking, focus on market failures, their work is about financial stability, consumer protection, I'm interested in the features of the system that are about political economy, about solving the problems that result from outsourcing a public function to enterprises owned by private investors. And what I'm going to argue is that one of the features of the system that is related to those problems is the Federal Reserve, which Congress created in 1913 to make monetary outsourcing work, both economically and politically. So approximate motivation for writing about the Fed is that the Fed's activities have changed dramatically over the past 14 years. And there's a lot of debate going on about what the Fed should be doing going forward. So here's a chart you've already sort of seen a version today of the Fed's balance sheet, not including cash in circulation. This one goes back to 59. And you see that the Fed doesn't really do anything with its balance sheet except issue notes up until 2008. And then it starts doing a lot. You know, it rescues Wall Street firms, lends to foreign central banks, buys trillions of financial assets, and then more recently even starts lending to ordinary businesses and local governments. And people disagree about whether this is a good thing. And some want the Fed to go further, combat problems like climate change, make direct transfer payments to households. Others worry about the Fed's expanding role. They say maybe they embrace the dealer of last resort role, but they fear real economy lending might trap the Fed in partisan politics. And so I'm motivated by this debate and the fact that the literature doesn't really engage with the statutory framework. People don't ask what the Fed was actually built to do. What is the institution for legally? It's common in the literature to treat the Fed as a kitchen sink agency, that has an amalgam of unrelated tasks and responsibilities, like issuing the money supply, which is generally treated as a form of direct public provisioning, regulating banks, which is generally analogized to regulating private businesses, and emergency lending, which is treated as a government credit support program. And these are very different sorts of things that the government does. And so, in the legal literature, there are frameworks for thinking about public provisioning, for thinking about private regulation, for thinking about government credit. And those frameworks are very different. And so on this approach, the Fed seems a bit incoherent to begin with, because it's doing all of these very different things. And it becomes hard if you think that it already has an incoherent framework to have a sort of legally grounded or institutional take on whether it should address problems like climate change. My approach is different. I go back to the statute and I try to reconstruct the institutional design, and what I see is that it's actually quite coherent. And I argue that to understand the Fed's growing role in our economy and also the stakes of the debate, we need to understand the underlying statutory scheme for money and banking. And that scheme reflects a distinctive American solution to the problem of creating a money supply that expands over time. And I think you'll find that the scheme is wildly out of step with current monetary conditions. There's no place for the FX swap market in the Federal Reserve Act scheme. And so it's quite striking. So I call the the US solution to the problem of creating an elastic money supply, the American monetary settlement. And this is an arrangement for creating money that emerges in the US at the state level in the 1830s and 40s after the Jackson veto of the Second Bank of the United States. And it's embraced at the federal level during the Civil War. And it reaches its apotheosis during the New Deal. Since the 80s, it has been progressively weakened. And we'll get to that if we have time. But I want to talk about the four core features of the scheme, most of which are still in the law, even though practice has deviated from the legal framework. And so the first feature is delegation. So outsourcing. So the U.S. legal scheme outsources the power to issue money to publicly chartered investor-owned banks. And the law purports to give these banks collectively a monopoly on monetary expansion, although the effectiveness of these monopoly provisions has varied over time. That's at least the intent. To render the outsourcing politically and economically durable, US law limits bankers in three ways. So it separates them from non-monetary business activities. So for much of US history, banks had very limited powers. They couldn't even engage in sort of financial commerce. They were meant to serve commerce, serve private financial activity. They were quasi-statal enterprises, and they were not supposed to compete with it. So banks couldn't be engaged in securities dealing or wealth management or insurance. Another key feature is diffusion. US has an unusually diffuse system. Banks were not permitted to branch or operate in multiple states. This is not about economics. This was not efficient. This was very inefficient. It was about politics. It was about legitimating an outsourcing scheme for money. And then a fourth feature is supervision. The US system empowers special government officials to informally monitor and control bank risk taking. And this dates all the way back to the 1830s and 40s, very, very early, before the whole rest of the administrative state develops in the US. And it's also about legitimating and making outsourcing work. So the Federal Reserve, on my account, is the capstone of this system. It's a sort of supervisor. Congress created it to solve three problems with monetary outsourcing. The tendency of privately owned banks to issue too little money, especially during economic downturns. And you see runs and panics. That was of particular concern. The second is an uneven playing field in the system itself. So large banks emerging as too powerful and concentrating credit in New York and Chicago. And it just generally a lack of public accountability and control over the system. And so the Fed is both a technical fix. It's trying to prevent instability and technical problems, and also a major shift of power toward the public from the private investors who owned the banks that made up the system up till that point. I get into the details much more in the paper, but I want to try to stick to my time. So the second half of the paper tries to draw some conclusions from understanding the Fed's purpose and function within the system. And so the first set of conclusions has to do with better understanding the Fed's instruments and institutional design. So from my account, the Fed isn't a kitchen sink agency. It has a coherent purpose to administer the banking system. Its tools are all ways for government officials to regulate bank money creation without resorting to the sorts of procedures we associate with other regulatory agencies in the Administrative Procedure Act. And so, the Fed's payment functions, its open market operations, its IOR, its regulation and supervision, its emergency lending, these are all about the size and composition of bank balance sheets. And many of the tools are actually interchangeable. And so the Fed uses open market operations and IOR to adjust the ability of banks to issue more deposits, but it could accomplish something similar using regulatory and supervisory tools if it wanted to. Those would just be more cumbersome. And emergency lending, in my view, is also meant to serve a monetary purpose. It's about stabilizing the supply of money in the economy. Even 13.3, which authorizes the Fed to lend to non-banks, was a monetary power. It was about the fact that a third of banks in 1932 were failing, and Congress thought the Federal Reserve banks should be able to step into the shoes of failed banks and replace credit arrangements, private credit arrangements that were collapsed. So the toolkit is coherent on my view. The institutional design is also coherent. So the 12-part Federal Reserve Bank network, this reflects the political settlement about diffusing control over monetary expansion geographically. The involvement of bank shareholders isn't so bizarre. In reserve bank governance, if you recognize that the national banks are completely controlled by private investors. The insulation of the board from the president also makes sense when you understand that this entity is a monetary entity. U.S. law in the Constitution itself puts the money power in the Congress as part of the fiscal power, and the framers were very concerned with avoiding executive interference with fiscal and monetary powers, and I get into that a bit more in the paper. The second payoff of understanding the statutory framework is that I think it helps us to make sense of what's been going on over the past 14 years. So, in my view, basically the root cause of the expanding balance sheet is shadow banking. Firms that are issuing dollar-denominated money claims without a bank charter, and these deposit alternatives are not really contemplated by the statutory scheme. So the Fed isn't designed to regulate the issuers, but because of their size, the Fed has to backstop them or accept punishing deflation. And this has created a lot of tensions within the framework. And so as the Fed has gone outside of the tools that it has been given and designed neutral swap lines, repo operations, which are not contemplated by the statutory scheme, it's caused all sorts of ramifications. It's changed the banking system, which has conglomerated, which has desupervised, which has expanded its activities in contravention of separation provisions. And today we have a monetary system that's much more driven by private investors than the one designed by the New Deal Congress, or even the earlier model set up during the Civil War before the Fed existed. And I think one of the impacts of shadow banking is quantitative easing, which I see as the product of the Great Recession, which was a deep downturn caused by a financial panic, and the realization that the Fed was willing to use its balance sheet to assist shadow banks led the Fed to be able to and feel it needed to use its balance sheet to address that recession. Real economy lending is even more clearly a political consequence of routine shadow bank backstops, and you see that in 2020. And so today's Fed is looking more and more overloaded as it tries to allow the monetary system to continue functioning, even though it is no longer lined up with the statutory scheme, which presumes that banks basically have a monopoly on deposit money. And so a third payoff is to reconceptualize the debate and to understand the arguments today about what the Fed should be doing in terms of the role of private interests, technocrats, and legislators in creating the money supply. And so our legal system has a particular vision about how those three sets of actors should interact. Legislators structured a system where monetary expansion is delegated to private investors, and technocrats are commissioned to administer their activities. Current arrangements deviate from that because they put private investors in the driver's seat through the instrumentality of shadow banks, which technocrats still administer, but the shadow banks were never chartered by the legislators. They're not subject to the same ex-ante controls as the banks. There's a new group of folks who are calling on the Fed to address climate change, aid municipal finance. They want to elevate technocrats above shadow banks and also above legislators in some way. And they see a larger central bank role in structuring the monetary system. overall, I find, maybe just wrap up, current arrangements quite unstable. I think the Fed has had to stretch the law more and more to hold the system together, especially internationally. And it's bringing us closer and closer to both a political and potentially monetary breaking point. And so going forward, I think policymakers need to figure out how to address shadow banking and alleviate some of the pressure on the Fed to operate the system.
Thank you, Lev. It was amazing, and thank you for the time constraint also. So I would suggest. Please mute your. Okay. We muted you. Lev, thank you so much for your very nice presentation. And in case you could share your paper in the chat, that would be great, because many of the members were requesting that. And let me continue by calling our third presenter, Chris Rimmer, who has studied mathematical modeling in his 15-year software development career. And he also studied at Oxford University. And in his career approach, he has found to model the economy. And Chris he has been applying his knowledge to the banking and economics since early 2008. Chris, can you please share your screen? And we are very pleased that you are here with us. And again, while you are doing so, let me thank Elham's presentation, and let me kindly draw your attention to the fact that Elham was also presenting last year too. So Chris, I really hope you and Lev are going to be with us next year's symposiums too. And after Chris' presentation, Tobias is going to discuss his presentation, and I would like to open the floor for Q&A. But due to the time constraint, I would like to ask Chris to be a little bit brief. Chris, the floor is yours. Thanks.
Okay, thanks very much. Can you hear okay? Okay.
Yes, we can hear.
Great. Okay, so yeah, thanks for the opportunity to present my work today. So I'm discussing my paper on the origin of purchasing power. So it's looking at where purchasing power comes from. So I'm quite new to the money view, so you might find this a bit basic, but I hope you'll find it's a useful complement to Perry Mehrling's payment versus funding paper from 2020. It provides a slightly different perspective, and in particular, I hope you'll see how the arrow notation I've been using can be quite helpful with intuition. So let me just give that the. I'm afraid sharing this seems to have stopped me from. Here we go. Okay. Right. Yep. So people familiar with the money view and other heterodox schools of economics are very conscious that modern money and credit, I'll just say money from now on, is a debt. It's an asset of the holder and a liability of the bank, and therefore creating money takes no effort. Now, most purchases are made with money. So does that mean that it's effortless to create purchasing power, that this is a form of alchemy? So I argue that it isn't, that it's important to distinguish between purchasing power and the means of purchasing, which is the money. So as we'll see, if creating money increases one person's purchasing power, it does so by decreasing another person's purchasing power by exactly the same amount. And at the end, I'll give my answer for what increases one person's purchasing power without decreasing another's. To help you follow my argument, I need to introduce an idea from an earlier paper I wrote called a macroeconomic model with exogenous human actions. And there I focus on an idea called raw net worth, which is what somebody owns, plus what they're owed, which I represent with a green token, or green tokens, minus what they owe, which I represent with pink tokens. So the first two are their assets, and then the second is their liabilities. So for example, Alice here owns this house and this car. She has $2,000 of savings in a credit union and owes $90,000 to a bank for a mortgage. And she also owes a bag of sugar to her neighbor, Bob. So her raw net worth is her house plus her car minus $88,000 minus a bag of sugar. Notice that raw net worth isn't reduced to a single monetary amount, and that's really important. It means we don't need to deal with valuation and revaluation. So when assets and liabilities change, it changes raw net worth. If assets go up or liabilities go down, then raw net worth goes up. And if assets decrease or liabilities increase, then raw net worth goes down. Okay, so I expect most of you are familiar with Perry Mailing's lectures and the notation he uses on the blackboard for changes to balance sheets. So for example, here's how we'd draw balance sheets for a bank and a customer. And if the bank creates a deposit for the customer, you'd represent it like this. We can use this green and pink notation, green and pink token notation to show the same thing here. So we have the new liability on the left and new asset on the right. So that's just one new IOU created. Normally there'll be an IOU created in the other direction as well, of course. So it turns out that almost all changes to balance sheets increase one person's raw net worth by exactly the same amount as another person's raw net worth decreases. So an economic action like this can be thought of as transferring some of one person's raw net worth to the other. I found it very useful to represent a transfer like that with an arrow like this. So here, there's an arrow going from the bank to Alice. So the bank's raw net worth decreases by $100 and Alice's increases by $100. The color gradient goes from pink to green to show that raw net worth is transferred from the new debtor to the new creditor. So this is an example of issuance, creation of a new debt. It turns out there are exactly 8 different types of economic action, and each I represent with a different color, a different arrow color. So this table shows one row for each type of economic action. When we read it from left to right, we'll see first the changes to each person's assets and liabilities. Then we'll see the changes to each person's raw net worth, as well as the total under the sigma. And then finally, an arrow representation of this kind of action. So first one is transferring a tangible asset. So this is where Alice gives Bob an apple. So she gets one less apple asset and he gets one more apple asset. And then in terms of their raw net worth, Alice's decreases by 1 apple and Bob's increases by 1 apple. And we represent that with this purple arrow. Next one is a new debt or issuance. So this is where Alice writes Bob an IOU promising to give him an apple tomorrow. Alice has a new liability and Bob has a new debt asset. Again, it decreases Alice's raw net worth by 1 apple and increases Bob's by 1 apple. So again, we can use an arrow to represent this transfer of raw net worth of 1 apple. Next one, transferring a debt asset. So this could be, well, in this case, somebody owed Alice an apple, and then she gave that IOU to Bob. So this is a decrease in her debt assets and an increase in his. Again, same effect on raw net worth, and again, the sum of 0. And again, we represent that with a green arrow. Here's a transfer of a liability. So this is where, actually, I won't go into that one so much. It's much less common. Here's writing off a debt, which is, Alice loses a debt asset and Bob loses his liability. So Alice is saying that Bob doesn't owe him an apple anymore. And again, it transfers 1 apple of raw net worth from Alice to Bob. This time it's from green to pink because it's a transfer from the creditor to the debtor when you write off a debt. This is where it gets slightly interesting. So this is production. In this case, Bob plucks an apple from a tree. So his raw net worth goes up by 1 apple, but nobody else's changes at all. So the Bob's raw net worth goes up by 1 apple, and the total and the whole world's net worth goes up by 1 apple. So I show this here by having an apple. We can see the arrows pointing to Bob, showing his net worth increases by 1 apple, but this represents nowhere. So nobody's net worth is decreasing. And then consumption, the opposite. Alice eats an apple, her raw net worth decreases by 1 apple, and the whole world's raw net worth decreases by 1 apple. And here again, we have an arrow going from Alice, showing her raw net worth decreases into nothingness. The final one is performing a service. So here, Alice is washing Bob's car. Doesn't affect anybody's anything on anybody's balance sheet. Jean-Baptiste Say realized that providing a service is actually equivalent to the simultaneous production, transfer, and consumption of what he called an immaterial product. So with that in place, we can now analyze a simple lending scenario. So for each transaction, we'll look at the transaction itself and then the cumulative effect up to that point. And today I'll just focus on the 2 most important stages of the whole lending scenario, but the paper examines all of them. So we're looking at where the purchasing power came from. So in this scenario, there's a guy called Ted who starts with no assets or liabilities. He wants to buy some expensive chocolate to eat. So he goes to the bank for a $50 loan, and apparently you can buy a bar of chocolate for $50. So here we go on the left. This is the first transaction, Ted borrowing from the bank. As Perry Mailing always says, this is a swap of IOUs. Ted and the bank each transfer $50 of their raw net worth to the other. So in fact, neither of them has a change in their raw net worth. And because it's first transaction, the cumulative diagram on the right is exactly the same as the transaction. So let's move on. So now Ted buys the bar of chocolate. He transfers his new debt asset, the bank deposit, to a shop, ROW's Rest of World. So he does that by using a debit card or a check, and then the shop transfers tangible asset, the bar of chocolate, to him. It's interesting to look at the cumulative diagram at this point. So the 2 separate transactions so far, which each involve 2 parties, are equivalent to a single 3-party transaction. So the bank has transferred $50 of raw net worth to the rest of the world by creating a new debt. The rest of the world has transferred a bar of chocolate to Ted, and Ted has transferred $50 of raw net worth to the bank, again with a new debt. So we can see this nice 3-way transaction that shows the mutual benefit to everyone concerned, or the mutual acceptable nature of the transaction to everyone concerned. Looking at the arrow heads and tails, we see that the rest of the world's raw net worth has increased by $50, but decreased by a bar of chocolate. Ted's raw net worth has increased by a bar of chocolate and decreased by $50, and the bank's raw net worth hasn't actually changed. It's increased and decreased by $50. Next one is Ted eating the chocolate. So this decreases his raw net worth without increasing anybody else's. Notice the arrows pointing to and from Ted in the cumulative diagram on the right show his raw net worth has increased and decreased by a bar of chocolate, but it's also decreased by $50. So we'll come back to this shortly. For now, notice that Ted owes $50 to the bank and he doesn't have any money or any other assets, so he needs to earn some money to pay the bank. It turns out they're exactly, sorry, wrong page. So, here we go. Sorry about that. So Ted decides to wash the windows of the shop, and he's paid $50 for it. He now has enough money to repay the loan. So we'll just skip on to the next one. So here Ted's repaying the loan, and notice how he does this. He writes off the deposit debt in exchange for the bank writing off the loan debt. So there's no cash involved at all in this. But just like the original swap of IOUs, Ted and the bank each transfer $50 to the other, leaving their raw net worths unchanged. If you look carefully at the cumulative diagram, you'll find that most of the actions in the entire scenario were reversed, and all that remains is a barter transaction. So if you look at this and you ask, how did Ted get the purchasing power to buy the chocolate? The diagram says it was by washing the windows, by producing a service. Let's go back to an earlier step where Ted had just eaten the chocolate. Remember, he started with a raw net worth of 0. It increased by a bar of chocolate and decreased by a bar of chocolate and by $50 by this stage. So his raw net worth is now minus $50. He's insolvent. If Ted died at this point, what would happen? Well, normally an executor would sell enough of the person's assets to pay any of their debts, and anything left would go to the beneficiaries in the will, but Ted has no assets. So what happens? The answer is he defaults. The bank is forced to write off the loan debt without getting anything in return because there's nobody to pay it. If we look at the cumulative diagram now, we'll see, interestingly, how Ted got to consume the chocolate. It was the bank transferred $50 to the rest of the world, and the rest of the world transferred the chocolate to Ted, who consumed it. So Ted's purchasing power came from the bank. It's even clearer if we look at what happens if the rest of the world withdraws the depositor's cash. So here it swaps the, it writes off the deposit and gets $50 cash. And then the cumulative diagram shows an actual transfer of cash from the bank to the rest of the world. The rest of the world transfers the chocolate to Ted, who eats it. So here we see that cash is, that it was the bank that, or Ted's purchasing power increased at the expense of the banks. Moving on. So in summary, here are the two possibilities. Either to be able to purchase the chocolate, Ted either had to produce something, in this case, a service, or somebody else's purchasing power was reduced, in this case, the bank. And those, it turns out, are really the only possible outcomes. If you're not convinced by these arguments that Ted's purchasing power comes from either his own production or at the expense of someone else, here's a quicker argument which convinced a friend of mine. So here again is the first stage of the lending scenario where Ted and the bank have exchanged IOUs. Here's Ted's new balance sheet. So he has a $50 deposit asset and a $50 loan liability. Now, the problem is he's not free just to spend the new money on something and forget about it, because it's all he's got to pay his new debt to the bank. He can use the deposit either to repay the loan or for spending, but he can't use it for both. Banks are in the business of providing temporary liquidity, allowing people to bridge the gap between buying and selling. So borrowing and then spending the new money in the market takes away goods and services which people could have bought with their existing money, but it doesn't dilute the existing money's value, because the borrower has to then sell other goods and services to earn the money back to repay the loan. So the rest of the world doesn't have less available to buy with its money, just something different. So if creating money doesn't create new purchasing power, what does? And so I'm just coming to the end here. So, so to purchase something, you must transfer some of your raw net worth to the seller in exchange. So raw net worth is purchasing power. And as we saw from the set of all the economic types, there's only one way to increase your raw net worth without decreasing someone else's. It's production. There's truly no alchemy, because production involves effort and or consumption of raw materials. And I claim that Jean-Baptiste Say was correct. It's production which gives someone the power to purchase other people's products.
Thank you so much, Chris. I agree, Jean-Baptiste Say was right. But let me ask Tobias Fohr from European University Institute, Robert Schuman Center for Advanced Studies, where he is a research fellow. Tobias, can you please discuss Chris' paper? Thanks.
Absolutely. You want me to put some other questions to the others' papers as well, or just Chris?
Let's first start with Chris, and
right.
after I would also like to Perry to comment the papers, okay. if thanks.
So thank you very much, Chris. I mean, I think I really appreciate the ethos where you're coming from, and I like how you're trying to use the money view to derive some very paradoxical results. And I think you asked some very good questions, right? Ultimately, sort of, or the way I read your paper, about the relationship between banking and money creation and the real economy, right? Like, and I think you are right that there's more to be said. And I think maybe you're also trying, I like that sort of, to figure out what the limitations of the money view are. Now, however, when it comes to your methodology and your conclusions, I disagree with you on a couple of things. And I think I can sort of highlight two items where that comes out, right? So you want to say, listen, there's no alchemy to all of this. because ultimately we have to produce things, right? And I think that part is correct. But I think the way you redefine purchasing power, to me, is really strange and not unhelpful, right? Because the way I read your paper, what you're saying is this: okay, imagine Ted gets a loan from the bank, $50, he can now spend it. But obviously Ted has to repay this loan. So that's not the creation. The creation is only in the fact that when he then does window shopping, that allows him to pay for the loan. And so that's where his purchasing power comes from. But at least to me, purchasing power is an abstract concept. You don't have to purchase something in order to have purchasing power, right? So that in your paper, you go through when people dies. So to me, purchasing power means if a bank gives me a loan for $50, that's purchasing power. Even if I never make a purchase, it's still purchasing power. And if I don't use it, then I don't use it, but that doesn't mean I didn't have the purchasing power. So I think you sort of redefine purchasing power in an important way, right? And I think that's important because, you know, what does banking allow us to do? Well, in some sense, it allows us to pull future consumption and future production into the present. And I think that's a really powerful function. And that already would allow us to say that there's some alchemy at place there, right? But I don't think it's right to say that, well, you might be getting the loan now, but what's really paying for the loan is the work you're going to do in the future, right? I think that's a step that then disregards how important it is that the loan was made now, right? Because again, I think when you show in your balance sheets, Ted and the bank don't have anything, they don't have anything to spend. The bank creates a $50 deposit, you do have something to spend now, right? You don't have to do the window washing first. And I think that's a really important thing. Now, if we then translate what you're saying over is, well, sure, so banking doesn't create products. Yeah, but I don't think anybody would be surprised by the fact that just creating money doesn't create products, right? And there is a question about, okay, so we're creating all this money in credit now. How is that going to relate to future production, right? And maybe we are creating so much money in credit now that it's completely disproportionate to the future production we can provide as a society. And as a result of this, we're going to get into all sorts of problems. But I'm not sure that redefining purchasing power from something that's sort of abstract and potential to having to make purchases in order for it to count would be a useful endeavor in this regard. That's sort of my reading of the paper, and I can go on more, but I know we're also running out of time, so I want to leave space for others.
Thank you so much, Tobias. Thank you. Perry?
So at the beginning, Chris mentioned my paper from last year, the second bit of the money symposium, payment versus funding. But he didn't close the loop at the end by connecting this up. So I will connect it up. In that paper, I talk about the flux, okay, which is the expansion of balance sheets, and that causes things to happen in the world. But the question is, what happens to those balance sheets after they're expanded? What restores portfolio equilibrium? And there were three possibilities. One, of money funding, that the money stays in circulation as it gets passed around. Another, that a debt gets repaid, and so the money goes out of circulation. And another, that the person who owns the money buys some financial asset. Anyway, you'd have to look at the paper. This is the second case, okay, where the new money is used to pay a debt. And in fact, here's a sort of counter proposal that if you think of the person who had the chocolate, okay, as receiving the money, okay, and then they pay off a debt, the money disappears too, Okay, there remains a liability of the chocolate buyer, okay, to the bank, but the money disappears without, and the liability is still there. So there are multiple possibilities that can happen to restore equilibrium. And I'll just finish by saying about alchemy. Okay, I just want to make clear that I use the word the alchemy of banking precisely to shock people who think that money is a thing, okay, just from their normal daily experience, you know, that something that can't be created out of nothing. And so I call it the alchemy of banking, a swap of IOUs. But it's not really alchemy. It's not really creating something from nothing, okay? Because the liability of the bank is a different kind of liability than the liability of my IOU. It's acceptable in payment because it's a spot liability. You know, my liability is not a spot liability. And the bank has to do very special things in order to ensure that it can deliver on that promise of spot payment. And that's where you start thinking about reserves and interbank balance sheets and stuff like that. So the alchemy was meant as a kind of a joke, not that you really are getting something from nothing, but that to shock our minds about the mystery of banking, to really bring on board and say it looks pretty alchemical. Let's try to understand this thing. Okay, that was my pedagogical kind of trick, and it generally actually works in the classroom, that students, if you call it alchemy, they're willing to accept it in a way that that normally they want, you know, they think that loans are made from reserves. You can't lend a bicycle unless you own a bicycle, but a bank can lend money even without owning any money. And so that sounds a contradiction, and you need to overcome that when you're educating students in their first money and banking class. That's just all. That's how I. Maybe it's a mistake to use that word because it leads to misunderstanding. But it does work pedagogically at the beginning. I'm here to attest.
Thank you, Perry. And I assume that you were also referring to George Soros' book of Alchemy of Finance, but I might be wrong here.
Well, so he has a different thing in mind. Okay, he does have in mind what Toby was mentioning, that you're imagining a future, okay, and then taking action to make that future come about by borrowing and spending. Okay, so you're exerting power on creating a future society. That alchemy he had in mind, and that is more actually alchemical. The question is, who gets the purchasing power? Whose dreams of the future get a chance to become reality? So the allocation of credit is at stake there.
Thank you for the clarification. Anush?
Just very quickly on alchemy, I actually think it's useful to capture the following feature of money, is that outside money is a thing to us. I can't create bank liabilities. The bank can create bank liabilities. And the bank can't create central bank liabilities. Only the central bank can create central bank liabilities. So for all intents and purposes, outside money is like a thing. And so the creation of money higher up in the hierarchy, a liability higher up in the hierarchy, does kind of look and feel like alchemy. So the word alchemy actually captures the following feature of the hierarchy, which is that there is a kind of, to use a Marxian term, a fetish created when you create outside money. It's all inside money. It's inside money all the way down. But from the point of view of lower down hierarchy units, up hierarchy liabilities look and feel like commodities. So alchemy is wrong in a strictly philosophical sense, but it is capturing this feature of the system, is that I can't create central bank money, I can't create bank money, I can only create, you know, AK liabilities or whatever. But so I just wanted to throw that in.
Thank you, Anush. If you don't have anything to comment, may I just call Bruce? Bruce, can you hear us? I would be very interesting to hear your opinion regarding alchemy and what Lev mentioned in the chat, creating a gold out of nothing. You, as coming from the practitioner sphere, and you are here with us since very early morning. what is your comments? Thanks.
Hi, Adam. Yeah, I appreciate the question. Can you hear me okay? I just turned the mic on. Yeah,
yes,
thanks.
we can hear you.
Okay. I think the labeling of what's happening as alchemy is accurate from my perspective. It's simply it's taking something that wasn't there before and now creating something that people can use to essentially settle payments and buy things that they would like to do, whether it's securities or hard goods. Thanks to the alchemy of banking. So yeah, from my perspective, that's a valid way to look at it.
Thank you for your comments.
Sure.
And I don't see any hands raised. So
yes.
Oh, Toby, the floor is yours.
I mean, if there's no right, I just wanted also to ask a question to Elham and Lev, if nobody else wants to ask, given that I thought they also had excellent papers. And just, it's going to be two quick ones, right? For Elham, it was just, I mean, there's so much in there, right? I can't even touch upon, but something I was struck by, right, is that FX swaps are bilateral, right? Whilst repo is at least supposedly to be trilateral or through a central counterparty, right? Do you think that distinction is important, and does that have ramifications for what you're saying? And then sort of the second question is, obviously, so FX swaps have margin calls and various other things. Repo, you have haircuts. How do you see the usage of these two instruments, right? Haircuts and margins for the two products, and what does it mean to participants? And for Lev, I just thought, really amazing presentation, super interesting. So, it's a really hard question, but what should be done, right? Should we change the charter and structure of the Fed? Do we need a new agency? Should we make all of this shadow money banking illegal and go back to the 1910s? What's your vision?
Okay, maybe we can also hear Karen's comments or question.
Well, I'm completely mystified by this discussion raised by Chris and discussed very seriously, because I think there's a basic question here about what is ordinary money that we use to buy for and which we earn by getting money into our accounts every month. I don't engage in transactions, in debt transactions to buy an apple. I take it out of my account by some means of payment, of course, but it is there. So shouldn't we distinguish between the ordinary monetary income circuit and the wealth and asset transactions? Of course, they interact. I know that, but as it is, most of us have an income, and that is most of the economy that is working that way. At least the working people's economy. So I would like to have an answer from more of you to this question: how to separate the different circuits.
Thank you, Karen. And I also saw Dan's hand. Dan, do you have, or that was from?
Sure. Well, thank you. Thank you to all three presenters, and I've put my questions for the most part in the chat just so they can. We're lucky to have too much to say to each other right now. That's a good thing. But I've left the record of my thoughts in the chat, so we can come back to them some other time. I'll just speak out loud my question to Elham, which I've seen this paper before, and there's a lot in it. Maybe this paper also is a book. It would be great to have more money view books out there. My question though was, I wonder if you have thought about how we can map some of your conclusions back from FX swaps to repo, because I think one of the key points you make is that deviations from CIP that are visible in FX swap rates can be traced back to a funding gap, a dollar funding gap experienced by dealers. But also, FX swaps are you also show that FX swaps have a natural funding structure, which is basically exactly parallel to dollar or repo. So how far does the analogy go? Is there a way to map this back onto the expectations hypothesis, or the slope of the yield curve, or spreads in segments of the repo market, where the conclusion comes back to repo, and then maybe it's possible that you're saying something which is a more general observation about market making in securitized money market instruments, which describes both FX swaps and repo. So that's a lot. That's a lot to say. That my question is a lot. So if you've thought about it, I'd be curious to hear. But also it could be something we come back to in the future. Thank you again, Elham, and all three.
Thank you, Dan. Your question is recorded, but I'm afraid that Elham has left the room, so she might reply to you later in a direct mail. So before we close the session, maybe Lev or Chris, do you have any final comments? Lev, I saw that in the previous panel you wanted to raise a question regarding the digital yuan, because you published a paper on the digital dollar. So if you want, maybe you can share your comments on that topic too. Thanks.
Sure, I'll just respond briefly to Tobias's question. I saw a bunch of other questions in the comments, and maybe I'll try to email responses later, just in the interest of time. So the question, what should be done? I think that shadow banking has to be formalized and regulated. So, the activity of banking has to be subject to the same regulatory regime wherever it's taking place. And this is how the rest of financial law works. So insurance law applies to the activity of insurance, regardless of how you structure the contract formally. Securities law applies to anything that functions as a security. And we have an agency, the Securities and Exchange Commission, that goes out and enforces the regulatory perimeter for securities law. So if you come up with some new way to structure a security, and you say it's not a security, and you try not to comply with securities laws, the SEC comes and they go to court and they force securities law on you. And oddly, this is not how banking works. And so if you do something that functions like a bank deposit and that it augments the money supply, there's no agency that can go out and get an injunction against you. There is the Department of Justice that can bring a criminal case against you. The Department of Justice has never used this statutory authority, which is poorly crafted, and this has been a disaster. And so there has to be some way to create a regulatory regime that applies across the board, or else we should just give up regulating banking at all. Bank regulation will have very perverse consequences if it's only going to apply in some places and not in other places. So there's a domestic side to this problem, and there's an international side to this problem, because shadow banking is taking place both onshore and offshore. The domestic side is fairly easy, in terms of a design. Congress has to give an agency the power to enforce the regulatory perimeter and then apply banking law wherever the activity of banking is taking place. And that means that, repo market participants either subject themselves to bank regulation or they term out their funding. Overseas, the US has to decide whether and to what extent foreign financial institutions should be permitted to engage in the creation of US money substitutes. And I think it's a complicated question to answer that implicates a lot of different things. But whatever decision the US makes in terms of the right of overseas entities to create US dollar deposit instruments, it can enforce whatever regime it wants through through its control over clearing. So you can't be in the euro dollar market if you don't have access to the US dollar onshore payment system and the Fed's books indirectly. And so just the same sanctions tool that's used to advance foreign policy could advance bank regulatory policy. So anybody that wants to be in the dollar banking business internationally would have to sign up to some sort of US regulatory framework, or else be cut off from the system altogether, in which case I don't think they would be able to do it. So that's sort of my rough sense, but I think there's a lot of work to fill in the details and then figure out a way to actually implement something like that. We have a very dysfunctional political system at the moment.
Thank you, Lev. Chris?
Yeah, so just a couple of things to say about the feedback. Thank you very much, by the way. I was going to say, I wasn't trying to claim that Barry was claiming that it is alchemy. So I was trying to agree, but in a different way, really. It's very clear from the paper that it sees it as just an expansion of the elasticity rather than actual alchemy. One of the things I do want to say, though, this I hope this notation is useful. I think as a way of seeing how smaller transactions can become the equivalent of a bigger, when combined, can become the equivalent of a bigger transaction involving more parties. I think does help to clarify some of what's going on. One thing I would say about the payment versus funding paper, and I'm not trying to be critical at all, is that at the end, the three endpoints in there do still have the mortgage debt, which was a new debt created at the beginning. So that one is what I tried to do was get to the point where the debts that were created at the beginning are all gone by the end. And finally, just a comment from something Karen said about spending money. She didn't think of it as being involved in debts, but it is very much spending a debt instrument. It is transferring a debt instrument when you spend money. But anyway, again, thank you for the opportunity to present and all the feedback.
Thank you, Chris Rimmer, Lev, Menand, Tobias for Elham, Saeidinezhad. Thank you for your contributions. Jay, the floor is yours.